Every serious trader knows the old line: time is money. In modern markets, money is time, quantified, priced, and sold in units so small they pass unnoticed. New York, Chicago, London, inside anonymous concrete bunkers, exchanges rent space inches from their matching engines, not desks, not views, milliseconds. The difference between winning and losing is the length of a blink divided by 1,000. When a marketplace sells proximity to its own heartbeat, the real product becomes clear. It is not merely access to stocks or futures. It is access to sequence. Who gets to see first, act first, and be recorded as first? This didn't begin with servers or fiber. Long before matching engines, there were messengers and birds, flags, and wires. During the Napoleonic era, couriers carried battle news across muddy roads faster than official channels. Fortunes rose and fell on those hours. Paul Reuter launched a tiny empire by using pigeons to ferry prices between Aachen and Brussels when the telegraph had a gap. Semaphore chains flashed coded signals from hill to hill. Telegraph keys turned grain and cotton into electricity and sound. The product wasn't barley or bank shares, it was time advantage. Knowing slightly earlier and acting slightly sooner. The 19th century added the ticker tape, a ribbon of letters and numbers that democratized information while preserving a hierarchy. The closer the office to the feed, the faster the tape, the better the odds. Latency wasn't yet a formal metric, but it already picked winners. Electronic order books replaced shouting in pits, and suddenly the slowest link was human. The best seat in the house stopped being the front row of a trading floor. It became the shortest cable to the server that matched bids and offers. Modern exchanges built climate-controlled cathedrals, raised floors, battery banks, diesel backups, around clusters of machines. In the center sat the matching engine, a digital referee that decided whose order arrived first and who earned the trade. Around it, in locked cages, hum racks of customer hardware. Copper and fiber patch cords cross-connect those racks to the exchange's core switch. Distances are measured in meters and nanoseconds. Colocation, in practice, is the right to place a computer inside that temple and tether it to the engine with a cable of known length and guaranteed performance. Not the public internet, not a city fiber route. A few meters of glass or copper and a promise, a deterministic path to the market's clock. Why does this matter? Because modern markets are time priority machines. When two orders compete at the same price, the one stamped first wins the queue. Not the algorithm that is more elegant, not the firm with better opinions, the one that arrives earlier. This is not a technical quirk. It is the organizing principle of electronic liquidity. Victory is measured in microseconds, and that time priority governs more than orders. It governs information. Market data, the official feed of trades and quotes, leaves the matching engine and fans out through a hierarchy of wires and switches. The ears closest to the engine hear the heartbeat sooner. See a change a sliver sooner, act a sliver faster. That sliver is rent. Once proximity is for sale, a race begins that never ends. Light moves more slowly in glass than in air, so even the straightest fiber, drilled through mountains, laid across cornfields, loses to radio. Rooftops along the Chicago-New Jersey corridor sprouted microwave dishes. Each tower sees the next, handing off packets in the open air, shaving whole milliseconds from old routes. Rain and snow knock those links out. So redundancy multiplies. Packet loss becomes a design parameter. Engineers tune forward error correction, mount dishes a few feet higher, hunt for unobstructed horizons. Millimeter wave appears, then laser links. Every physics constraint turns into an engineering culture. Serialization delay on a network card matters. Kernel bypass networking matters. CPU cores are pinned and caches warmed. Switch hop latencies are measured like a land surveyor's map, annotated and litigated, all to gain a handful of microseconds, because those microseconds decide the order in which the world is written. Rules mint those microseconds into money. Fragmented markets, best execution obligations, and an official national best price all imply time to aggregate. When venue A moves first and venue B lags, the scene becomes a toll. Colocated systems that see A's move can race to B, harvesting the difference before it vanishes. Maker-taker fee models and rebates transform queue position into a financial asset. Being first in line to get hit becomes as valuable as the price level itself. Depth of book feeds, futures, and ETF relationships, and cross-asset signals add structure. Every relationship is a spring that wants to snap back into balance. The first hands to push it have the advantage. Nothing here violates the law. Everything here depends on the rulebook. The system sells fairness as a technology service and rations it with pricing. Stress is an X-ray. Sudden volatility makes speed visible. Flash crashes, rumor spikes, wild prints. The moment the market shakes, the race determines who escapes and who is trapped. Some strategies pull their quotes to avoid being picked off by faster hands. Others fill the vacuum and take on risk. Feedback loops emerge. Algorithms react to the reactions of other algorithms before a human desk even notices the first tremor. This coupling cuts both ways. A single firm that deploys a bug can flood the engine with self-defeating orders and hemorrhage capital in minutes, not because a rival out-negotiated them, but because their clock was misaligned with reality and the machines did exactly what they were told at maximum speed. When everything is wired to respond in microseconds, mistakes become instantaneous and expensive. Colocation is not an incidental service, it is a product line. Exchanges sell rack space measured in units, power in kilowatts, cross-connects with committed specifications, and premium data feeds that arrive ahead of consolidated public tapes. They standardize the final meters of connectivity so that everyone inside the cage has equal cable lengths, equal switch paths, equal access to the engine's notion of time. Customers buy predictability, latency that doesn't jitter, sequences that don't scramble, a clock that matches the one that will decide who is first. The exchange monetizes a constant of the universe by turning it into a commodity, the reliable right to be earlier. Consider how the economics stack. Retail order flow often seeks wholesalers that promise price improvement and speed. Market makers internalize that flow, hedge on lit venues, and arbitrage-related instruments to keep risk flat. Prop firms chase seams between venues, between products, between the public feed and the private view in the cage. Long-only funds rebalance to indices, algorithmic desks slice big trades into small ones. At the center, the exchange gets paid for listings and for time. Everyone builds around the assumption that sequence is a marketplace, and sequence can be bought. Is this good? The defense notes that spreads narrowed, explicit commissions fell, and liquidity on screens often appears deep. In a world governed by time, priority, paying to remove random citywide network noise and collapse, the distance to the engine creates a tidy contest over code, risk, and inventory, rather than over who bribed which ISP for preferential routing. Anyone who can afford a cage can enter. The rules are published. The firms at the front of the line take on real obligations. They post quotes that others can hit and bleed when the market turns. They warehouse risk a few microseconds earlier than the crowd, and in doing so, provide immediacy. The prosecution answers that explicit costs fell while implicit taxes rose. A tiny priesthood can afford to rent the first look and converts public information into private rents by skating the seams the rulebook never intended. Queue position becomes a wealth funnel. Market microstructure becomes an esoteric language that excludes most participants. Engineering talent that could build vaccines or bridges is pulled into shaving nanoseconds because the returns are immediate and quantifiable. The market sells the right not to know a secret, but to stand one step ahead in the line where secrets become public. When best execution can be gained by physics, the moral logic gets hard to explain to anyone outside the temple. Reformers apply friction. Speed bumps insert a fixed delay, hundreds of microseconds of pause, so that being 5 microseconds faster stops mattering. Frequent batch auctions collect orders for a few milliseconds and execute them in discrete batches, so that the first hair to cross the line yields no advantage. Randomized delays blur predictability. Symmetric access policies attempt to equalize last-mile conditions. Symmetric access policies attempt to equalize last-mile conditions. Latency floors keep the race within human comprehension. Yet fairness slips away like water through fingers. Slow the matching engine, and the contest shifts to prediction rather than arrival. Batch orders, and the contest becomes forecasting the batch. Ban one trick and 1,000 other tricks swarm in to replace it. Markets adapt. Capital genealogies discover every crack in concrete and widen it. The geography of time is written into maps. Anonymous buildings in Mahwah, Carteret, Secaucus, Aurora, Slough, Basildon, each a temple of time. Anonymous buildings in Mahwah, Carteret, Secaucus, Aurora, Slough, Basildon, each a temple of time. Inside, blue cage doors hide rows of servers, each one an instrument built to hear and answer the engine's pulse. A few cabinets closer to the switch translate to nanoseconds. Dishes on rooftops point at the next horizon, tracing straight lines across counties. New undersea cables advertise saved milliseconds like a luxury amenity. Job titles drift: RF engineer, network optimizer, kernel developer, market microstructure researcher. The word trader describes a person whose hands do nothing during market hours. The machine they design does the trading. The edge is built the night before, converted into money the next day, and dead by the weekend. What actually happens inside a rented millisecond? Imagine a large ETF prints a trade that implies its basket is slightly mispriced. In the first 250 microseconds, colocated systems absorb and validate the tick, update their estimate of fair value, and compute adjustments for dozens of related symbols. Update their estimate of fair value and compute adjustments for dozens of related symbols. In the next 250, they cancel stale quotes and post new ones, trying to hold queue priority while dodging adverse selection. In the next 250, they scan other venues for straggling prices that Haven a T adjusted and fire immediate or cancel orders to pick off the leftovers. In the final 250, they hedge futures against stocks, options against futures, swaps against options, closing the loop. The millisecond didn't conjure value from nothing. It enforced a web of relationships that would have equilibrated within seconds anyway. The reward is for providing immediacy, now instead of soon. Whether that immediacy is socially valuable depends on the value assigned to now. Complexity functions as a moat. A cage in the right building 1T generate profits without a stack. Deterministic software free of lock contention, kernel bypass for predictable network latencies, NUMA-aware memory placement, forward error correction, tuned for the vagaries of rain on microwave routes, microstructure literacy about queue dynamics and adverse selection, and risk control capable of reconciling microsecond decisions with tail events that emerge over minutes or hours. The barrier is not only the fee to the exchange, it is the years of engineering required to turn microseconds into a consistent, defensible edge. Who pays and who benefits? Long-only investors often enjoy tighter spreads and cheaper executions than a generation ago. Retail orders frequently receive price improvement from wholesalers. Active managers face a different challenge. Execution quality depends on brokers who understand the time map, venue selection, order types, midpoint pegs, hidden pools, and the choreography of child orders across fragmented venues. The fastest firms recoup rent on a millisecond in basis points spread across millions of shares. Exchanges convert speed into durable revenue, funding the infrastructure whose reliability underwrites the system. Society inherits markets that hum close to 24 hours across regions, a near constant auction of risk and opinion. Liquidity flows like electricity until a transformer trips. When the machine stutters, it stutters everywhere at once. The frontier keeps moving. Futures, FX, options, and crypto each nurture their own colocation ecosystems. As machine learning sinks deeper into execution, models train not on macroeconomic headlines, but on microstructure. Not is GDP strong, but will this queue flip in the next 200 microseconds if a quote moves 2 ticks? The contest pivots from who can be fastest all the time to who can choose when to be fast and where. The architecture escapes finance entirely. Sports betting exchanges, digital ad auctions, and AI inference marketplaces begin to resemble microbatch exchanges where latency is value. Anywhere decisions are auctioned in real time, someone will build a toll booth at the boundary between now and soon. History offers a few blunt lessons. First, speed becomes money only when rules turn time into priority and when venues fragment enough to create seams. Alter the rules. Use batching, randomization, or symmetry, and the race shifts dimensions from arrival to prediction, or from raw speed to inventory management. Second, crises expose the edges. Many liquidity providers are, in effect, selling options on stability, collecting tiny credits for being first when conditions are smooth, paying large debits when conditions explode. Risk systems must think at 2 scales at once, microseconds and tail events with no contradiction between them. Third, renting a millisecond is morally ambiguous. It compresses spreads and enforces price relationships quickly. It also creates a toll for immediacy that only some can pay. The difference between social good and social annoyance rarely lies in ideology. It lies in implementation, access policies, data symmetry, the evenness of cables inside the cage, and the humility to admit that the race will always reappear in a new form. Underneath the cables and cages sits something almost philosophical. Markets once rewarded the best shout in the pit. Now they reward the best timestamp at the engine. That timestamp is not trivial bookkeeping. It is the story the market tells about itself. Who acted, in what order, at what moment. Cell proximity and sequence becomes a revenue stream. Price the last meters of fiber and fairness becomes a service tier. The exchange is no longer just a stage for competition. It is a vendor of time. There is a simple clarity in that idea. If markets exist to discover prices eventually, an arms race for microseconds looks wasteful, a misallocation of brain power and capital. If markets exist to discover prices immediately, microseconds are the raw material of honesty, the fastest path from information to action. Reality likely sits in between. Some immediacy is plainly useful. Delays create slippage and uncertainty. Some is plainly self-referential. Shaving 1 more microsecond doesn't help an end investor as much as it helps the firm that shaves it. The line moves with technology, with rules, and with the ingenuity of the people who wake up each morning to move it. So colocation continues, quietly and expensively with a straight face. Cages fill, cross-connects light up. New towers appear on new roofs to shave another fraction of the human blink. The race begins at the moment an exchange opens its door, and it refuses to end because the prize isn't a number on a screen. The prize is authorship. The first look defines the next look. The first move shapes the next move. A rented millisecond isn't a souvenir. It's a small lease on the future. There is a strange comfort in recognizing that none of this is entirely new. Pigeons were a prototype. Telegraphs were a prototype. The ticker was a prototype. Every era compressed time, fought over access to its compression, and wrapped the results in the language of fairness. Today's version happens to speak Ethernet and microwave. Tomorrow's version will speak something stranger. The pattern will hold. Markets tax the slow and tip a share to whoever carries information across the gap first. What remains is a choice, not a referendum on technology, but a design question. How much immediacy is worth paying for, and who should pay? What structure keeps the race productive rather than predatory? How does a marketplace that sells time also preserve the story it tells about fairness? Those answers do not appear in ad copy for new cables or press releases about new colocation wings. They appear in rulebooks, in arm's-length audits of symmetry, in the willingness to add friction when edges become razors, and in the discipline to measure social value in more than microseconds saved. The market will keep paying for speed until the marginal microsecond costs more than the marginal improvement it brings. Then, new rules will arrive, or new physics will intrude, and the contest will shift to a different track. But the instinct will not vanish. Somewhere, someone will always try to buy a sliver of the future before everyone else. That is the quiet truth behind the cages and cables. Colocation is a marketplace for that sliver. If this gave you a new perspective, hit subscribe. History has the answers. Look closely.